Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, U.S. stock futures falling this morning over increased concerns on the conflict between Israel and Iran as President Trump has called for the evacuation of Tehran. The president's comments come after he left the G7 meeting in Canada early, but said his departure had nothing to do with working on a ceasefire between Israel and Iran, adding that his reason is much bigger than that. Investors were also looking for progress on trade deals at the event in Canada, but none have materialized so far. Plus, the Federal Reserve kicking off its two-day meeting in Washington with investors looking for any clues on the central bank's path forward for interest rates. Economists and investors widely expect the central bank to keep rates on hold as the Fed grapples with economic uncertainty from White House policy. And the CEO of Elon Musk's X social platform weighing on the state of the advertising industry after the Wall Street Journal alleged the social media company had threatened to sue advertisers that didn't buy ads on the platform. Yacarino says the company is seeing an influx of ad spenders.
96% of our advertisers coming back, and a tidal wave of new advertisers coming back. Think about partners that want to be in the gaming conversation, that want to be in the AI conversation. It happens on X.
President Trump said his early departure from the G7 summit was due to much bigger things than a ceasefire between Israel and Iranian leadership. The comments come as Iran and Israel trade strikes for a fifth straight day. President Trump urged residents in Tehran to evacuate before it is too late. Here to discuss is Terry Haynes, Pangea Policy founder. Terry, you read words like before it's too late and evacuate coming from the U.S. president. What does that signal to you about their and the involvement, the timing and the involvement then that President Trump might be dialing up?
Well, that ought to be a very clear signal to markets that, this conflict is not like the other conflicts. The markets are very used to looking at Middle Eastern conflict of a variety of kinds, whether it be the Gaza conflict, whether it be the trading of missiles that Israel and Iran did a few months ago, and saying, well, these are going to resolve pretty quickly, and it's not going to fundamentally disturb what's going on here. But this one's not like the other ones. What you've got here is you've got a situation where one party thinks that its existence is at stake, and the other party thinks the existence of its regime is at stake. And what that means is these things aren't going to stop anytime soon. Regardless of how you feel about Gaza, no one can deny the thoroughness of Israel's ability to reduce a particular region. And I think what the president is saying fundamentally is, watch out, because if you don't come to the negotiating table and actually come away with a deal pretty quickly, that's what you're going to be facing in Tehran.
And so the markets tend to try and price in whether or not there will be spillover effect. So it sounds like you're saying we should be anticipating some type of spillover.
Well, I think the likelihood that this morphs into some kind of a general regional war is much greater than all the other incidents that I talked about, precisely because of that existential view on both sides, and there's been a lot of talk about a lot of potential issues, including Iran saying that they might close the Strait of Hormuz, questions about whether other Gulf powers would be interested in helping or hurting that particular effort. But there's a substantial possibility. I wouldn't have put it over 50% right now, but there's much more than a trailing risk that what you've got here is a situation that spins into having significant knock-on effects for the global economy, particularly energy.
And so with this in mind, a lot of focus is also on where President Trump left in order to prioritize what he then was posting about on social media, and leaving the G7 summit is really looked at as, okay, well, where are some of these trade deals going to net out, especially with some of the main negotiating partners that were sitting there at that round table.
Well, fair enough. But at the same time, and I was one of the people who said a couple of days ago, look for advances on trade, and we saw a little bit of that with the signing of the U.S. UK first phase deal. But they're just not here as we sit in mid-June with a rough deadline of July 4th to July 9th. They're not ready to conclude negotiations. And when I say they, I mean really both sides, both the United States, Japan, the European Union, others. They've got a few weeks to do that, though, and in this world, that's an awful lot of time. Firstly. Secondly, there was nothing to be done at the G7 on geopolitics. The signals coming from the G7 before the meeting itself was, we're going to stand strong with Ukraine, but most of the countries which are in the European Union aren't prepared to do anything more than reiterate that they're standing strong. They don't mention really Israel or Taiwan at all, the other two major hotspots. And the president probably concluded that it was much better to get back to the sit room and figure out what was going on with some precision and map out a variety of potential responses depending on if the United States gets in or gets out. Now, the president has been very forthright about saying he's not going to get in unless the United States is directly attacked. But you're the president; you want options on the table, and you want to cut through those, before that eventuality.
And so with this in mind, as we are continuing to look for some of these trade deals, what is the risk that we don't have enough of what Scott Bessent has called good faith negotiations prior to the expiration of this pause in early July, which was going to be used as the basis for then extending a pause even further?
Well, my instinct, and nobody's going to trade on my instinct, but and they shouldn't. But my instinct on this all along has been that the U.S. UK deal is a good template for what to expect. The president is not a fan of wanting to spend years, maybe getting a trade deal in the kind of in the short strokes. What he is interested in is making sure that that the heads of two countries have a framework in which that can then be filled out. I would look for that with Japan. I would look for that with India. India has been very forthright about saying how it views the path forward. It wants a first phase by July 9th, second phase by October, that sort of thing. There's been no indication that the United States is pushing back on any of that at all. So I think what you're seeing, frankly, is a desire by the United States as much as by the other countries to want to cluster trade deals around the July 4th holiday. And Trump hopes by then you'll also get the additional boost of having a new tax bill in place. Mm-hmm. They intend that combined, they're going to get a substantial economic boost out of that.
Terry, good to have you here with us. Would love to continue the conversation, of course. Appreciate it.
Thank you, Brad. Appreciate it.
President Trump throwing cold water on hopes for truces between Israel and Iran, but investors are also watching the Federal Reserve meeting in Washington. It kicks off today, and any progress on trade deals, that's also on the docket and in focus. So what's the one area investors need to focus in on amid a mounting wall of worry? Joining me now, we've got Jeff Krumpelman, who is the Mariner Wealth Advisors Chief Investment Strategist and Head of Equities here. Jeff, if there was kind of a ranking system, if you will, of prioritization for what investors should be paying closest attention to and giving the most prioritization around, what would that be?
Wow. The $64 million or $1 trillion or whatever question. You used the word wall of worry just a few seconds ago, and there are just a number of items out there. And as you know, our thesis this year has been clear air turbulence, where we just expected heightened volatility and significant pullbacks on our way to higher highs and reasonable returns this year. And it's the plethora of issues that are out there. Trade is, very important. Your prior guest mentioned both geopolitics and trade. I think those issues are probably paramount. But, we take our clues not from, all of a sudden we've had to become, as portfolio managers and strategists, policy experts. And we're not. We certainly have a network of people we rely on. But I think what we take our clues from is the data, the fundamentals of the market, the valuation levels, and the technical trends. And while you have these policy risks that will push around maybe PE levels, what ultimately drives the market is earnings, the various economic data, credit spreads, and that type of thing. So that's what we're going to take our clues from and watch them very, very closely. And policy may or may not impact those ultimately. They might just push around PEs and cause psychiatry and fear. That's okay.
Sure.
But if inflation elevates, if interest rates push through 5%, if earnings slow down significantly and profit margins stall, those are the issues that we're looking at.
You mentioned taking your cues from the indicators as well. Is there a chief most technical indicator right now that you're kind of using as a guidepost to really influence or inform investment strategy, given all the moving parts on very key prioritizations, both in Washington and on a couple different fronts, both FOMC-wise and then additionally Capitol Hill?
So it's a mosaic. And on the technical front, we look at sentiment, which is very important. It's right now still negative, which is the contrarian positive. So, you've got a lot of money that can come back into the market on the sidelines if just we get a little bit of good news on any of these fronts. You don't want to become uber bearish at this point in time because folks have been bearish, and generally that's a positive for confidence to improve and the market to benefit from that. We look at things like the percentage of stocks trading above the 20 or the 50 and 200-day moving average. That gives you, just a sense for momentum. We look at advanced decline, which gives you a sense for breadth. And when we look at all those factors, quite frankly, they're neutral and they've improved. And they give you a sense that after the tariff timeout, that low point at one point looked like, we had perhaps, drawdown to maybe the 4,300 level.
Right.
Now we've got plenty of support of well above 5,000 in any kind of pullback. So I think that range of outcome that could occur because of these policy risks has tightened up post the tariff timeout. That's what the technicals tell you right now.
Jeff, really good setup for today's trading session. Thanks so much for taking the time ahead of the opening bell.
Thanks a lot.
Coming up on Morning Brief, we sit down with the CEO of Elon Musk's X social platform to discuss the state of advertising on the platform itself. Our conversation with Linda Yaccarino next on Morning Brief. Yahoo Finance executive editor Brian Sozzi is out at Cannes Lions this week. Today he got a chance to sit down with the CEO of X, Linda Yaccarino. They're covering everything from advertising on the platform to Elon Musk's work at Doge. Take a listen.
Your company has been in the news, to say the very least, in the lead up to Cannes. I'm sure you saw the Wall Street Journal story saying that pressure tactics were being used against the likes of Verizon, Ralph Lauren, to get these big companies to advertise on your platform. Now, there was no comment in that story. Where do things stand right now? I want to open up the table to you.
So this is how it's going. This is how we're starting. You're right. There was no comment in the article. There was also no named sources in the article. They had some random third parties comment on unnamed sources. So with the absence of both facts and named sources, and then the absence of the setup of the story, which was the House Judiciary Committee's findings and evidence that addressed a real coming together to boycott the platform, that was really the story and what precipitated any type of further inquiry from the House Judiciary Committee. So it was X who was conspired against. So that being said, I'm not in a position to talk about their business, but when you're in a position of the trajectory of where that business is going, it's really about what we're doing here in Cannes this week and talking about the historic evolution of the platform. And the historic evolution of the platform for 96% of our advertisers coming back, and a tidal wave of new advertisers coming back. Think about partners that want to be in the gaming conversation, that want to be in the AI conversation. It happens on X. Why? Because X has emerged as the world's most consequential culture signal. And when you sit in that position to be the mirror and the microphone of the world's real-time conversation, that's why the historic turnaround of X has happened.
Do you believe these big companies are conspiring against X and the things that you want to do in terms of trying to grow the platform?
Here's what I think about our partners on X. Our partners on X are embracing the scope of our ambition, the pace of the innovation, and really, really leaning in to the consequential dominance of our platform when you think about it. You know, a little over 2 years, almost 2.5 years ago, when Elon bought the company, we were 280 character messaging app with a minute or two of video. I mean, you know the platform.
I've been on since 2011,
well.
I think.
Thank you for
I'm
that.
verified, Linda.
Thank you for that. But when you think about the evolution in that short period of time, when you're looking at nearly 300 product innovations that have been rolled out in that short period of time, most other companies don't do that in a decade. So now when you look at a platform that is already with video capabilities, right? Up to 4 hours of video, soon to be unlimited video. Think about just that piece of the capability sophistication. That's why there's growth all over the platform. Gen Z is driving that growth. 40% increase in viewer consumption, video consumption versus year ago. That's why our customer base is growing extraordinarily well, particularly driven by Gen Z. And when you look at Gen Z, that by 2030 is going to have a spending power of $36 trillion, you have to be where the growth is. And our advertisers follow the eyeballs, and those eyeballs and growth is on X.
Do these stories make it harder to have the conversations you need to have here at a key event like Cannes?
Well, considering I don't have a minute to spare, what's exciting about the conversations and the meetings that we're having is about, again, the historic evolution and success of X. Look what we've been doing under everyone's noses. What it requires my team is to keep your head down, do the work, forget the noise, because the insatiable lure of a clickbait article, we're used to that, right? But when you look at video, when you look at the impact of Grok on the platform, and you look at X Money about to launch in the US, that's when you look at, oh my gosh, that was the vision of the Everything app all along.
I'll go here, X Money. I was going to say this to the end. You can confirm that it's going to launch this year, and what is that?
X Money is another example of us leaning into and really maturing into the Everything app. So think about it simply said. All the scope of the ambition and pace of the innovation at X since Elon acquired the company, there's really no peer, right? So you think about what is the Everything app. It's more people coming to the platform, spending more time to do more things. So when you're able to ultimately have financial services on the platform, imagine we'll launch with peer-to-peer payments, stored value, pay a creator. I could pay you for the pizza that you hopefully will buy me tonight, right? So think about that capability. Shortly after that, you will have investments and trades. You'll be able to live your whole financial life on the platform.
And this is all launching this year?
Yeah. We'll start in the US and then there'll be quick follow with expansion globally. But imagine what that creates. It's big lure for creators on the platform. We'll be able to buy merchandise, tip a creator. Imagine the content that then flocks to the platform. So in a whole commerce ecosystem will will really emerge and thrive on the platform. So it's really exciting next step in the evolution of the Everything app.
How is Elon's involvement with the administration, his work with Doge, how has that impacted the work you're doing on the ad side of the business?
Again, we concentrate on the innovation that we've delivered, the product enhancements, the growth of the platform that advertisers are interested. What are they interested in? They're interested in this world's most consequential culture signal, right? So when you take the culture signal that only X can deliver, it's the only platform that has real-time conversation data. How can an advertiser infuse itself in real time into a conversation of the consumer they're trying to reach? That's their North Star. And now that X is being fueled so aggressively by AI, I'm sure you know, being on the platform, about Grok's impact on the platform, that's the North Star for an advertiser. And those are the conversations that we're having with them here at the conference.
Now time for some of today's trending tickers. We are watching T-Mobile, solar stocks, Eli Lilly, and Verve Therapeutics. Yahoo Finance's Josh Schaefer is here with me on set to help them get broken down here this morning ahead of the opening bell. First, let's talk SoftBank here, trimming its stake in T-Mobile, selling $4.8 billion worth of shares. According to Bloomberg, the company sold 21.5 million T-Mobile shares for $224 each. The sale is expected to help fund the company's plans for artificial intelligence, and as of March, SoftBank held about 7.5% of T-Mobile's common stock. Shares of TMUS, you're seeing them move lower here pre-market. And of course, this has been an evolution in this relationship over years now, given the considerable stake that SoftBank has had in T-Mobile after the acquisition of Sprint.
Yeah, Brad. I mean, SoftBank's been in this name a long time, right, too? And you don't exactly know when in recent weeks or months that the sale, I think, was made, right? We don't know the exact date that this happened, but T-Mobile had just been trading near a 52-week high at the end of April. It actually had a pretty nice bounce off the bottom over that April run too. So the stock was in a pretty good relative position versus when it had been at. So if you were a long-time holder, if you were SoftBank, a large holder, or maybe just a long-term investor, sometimes that's when people would maybe take gains a little bit, right? So I think the timing of the timing of the sale, and especially as you said, SoftBank essentially just looking to reallocate capital into other projects, right? Other investments, seems to make some sort of sense.
Yeah, spot on here, and especially as we're seeing even more potential types of competitive measures kind of arising, especially on the low end side of the phone market here as well, and carrier market.
You talking about Trump phones?
Well, an acknowledgement to it at least, I suppose.
The emergence of Trump phones.
I said a smaller competitor to it. As we're also tracking solar stocks here this morning, this one is interesting as they are plummeting after a Senate panel proposed phasing out solar and wind energy tax credits by 2028. It's part of the Senate's revisions to President Trump's sweeping tax bill. Under current law, the tax credits would not start phasing out until 2032. You're taking a look at Sunrun, SolarEdge, First Solar, some of the most popular and most voluminous tickers, especially within the solar stocks landscape.
Yeah, Brett, I mean, that's why a lot of these stories haven't worked for a while now, right? I think there was fears that this would perhaps happen under the Trump administration. You just highlighted Sunrun. I was looking at a 6-month chart of that. You had a massive short squeeze on it early in May, but generally speaking, the stock has not worked for like over a year now. And I think some of these stocks have just kind of been in a little bit of a secular downtrend while the rest of the market has been rising, perhaps over fears of the disappearance of those government subsidies, because it really is a large part of the business.
100%. And taking a look here at Eli Lilly, finally announcing a deal to acquire gene editing company Verve Therapeutics for up to $1.3 billion. This partnership is looking to advance one-time treatments for people with high cardiovascular risk here. The deal is expected to close in the third quarter of 2025. There was one eye-popping figure that jumped out to me, and it was the premium here that they were disclosing. Purchase price payable at closing represents a premium of approximately 113% to the 30-day volume-weighted average trading price of Verve Therapeutics shares here. There you're taking a look at both of these companies, Verve jumping by 75%.
There's your premium, right, that you just pointed to, right? Yeah. You're seeing that massive move in Verve. But interesting, though, to see Lilly shares not really moving at all. Sometimes companies make a purchase and shares will fall a little bit, but that's not really playing out here. Of course, Eli Lilly had already been involved with Verve to some extent too. So I don't think if you're an investor, this is necessarily a shocking move.
You can scan the QR code below to track the best and worst performing stocks of today's session with Yahoo Finance's trending tickers page. We've got all your markets action ahead. Stay tuned. The opening bell comes up in just a few minutes. You're watching Morning Brief. There you're taking a look at the opening bell at the New York Stock Exchange, where Virtu Financial is today's bell ringer. And at the NASDAQ, you've also got the folks over at Casella ringing today's opening bell, celebrating what looks like 50 years. Congratulations to them on 5 decades, half a century. Taking a look at today's opening move here, as we've got the major averages here in the U.S. loaded up for you on screen. Let's populate this chart, why don't we? We'll give you a trailing 5-day look at things here, where over that period we're down 0.8%, but out of the gate, focusing on that number, we're down by about 0.4% for the Dow Jones Industrial Average. The NASDAQ Composite, you're seeing that as well, open to the downside here just a smidge, and then additionally fractional declines out the gate for the S&P 500. Let's dive into some of the heat maps here as we're tracking the sectors. We'll get back to this NASDAQ 100 view. You can catch a glimpse there for a hot second, but we'll come back to it. S&P 500, 11 sectors loaded up here on the screen. Energy, and this has been kind of the teetering, the seesawing over the past few sessions, where yesterday's session we began and 10 out of 11 sectors were in positive territory, and energy was the only decliner. Well, here, once again, in some of the ratcheting higher and the uncertainty in the Middle East, you're seeing energy once again being moved by some of the oil price expectations and the movements that we're seeing in Brent and WTI. So energy right now is up 0.7%, the lone gainer, and you've got 10 out of 11 laggards to begin today's trading session. Consumer discretionary right now, you're seeing that to be the biggest laggard of them all. That's down by about 0.6% here, but it's got plenty of company here on the day as of right now. Let's take a look at the technology landscape right now, specifically within the NASDAQ 100, as you're taking a look at some of the mega cap tech stocks. Yeah, NVIDIA is, and as well as Meta right now, with its flat but bare gains right now. It's up by about 0.1%. NVIDIA is, Meta flat, and now it's teetering here, seesawing just a little bit out of the gate, as you see that flat but to the downside move here. And then additionally, we were just breaking down T-Mobile and SoftBank exiting some of their position with T-Mobile here, and so that selling of shares pressuring the stock. That's down by about 3.8%. right now. And then lastly, we'll take a look at the Dow 30 components here on the day. And out of the gates, as of right now, you've got just a few gainers here on the day. Quick count looks like about 5 gainers, 6 gainers as of right now. Things moving around. But the biggest decliner as of this point, which was actually our biggest gainer to the upside to start yesterday's trading session, that's the swoosh, Nike. Well, we've got much more to track as we've just begun today's trading activity. Chevron leading the pack here, as well as Salesforce seeing fractional gains. But let's get back to the big story that we are tracking. Uncertainty in the Middle East weighing on the markets at the open, but the Bank of America Global Fund Manager Survey finds generally investor sentiment is returning to pre-Liberation Day levels. Joining me now to break it all down, we've got Yahoo Finance's Josh Schaefer. Josh, what's jumping out in this Global Fund Manager Survey? Yeah,
Brad, so you mentioned pre-Liberation Day sort of sentiment, right? Michael Hartnett over at Bank of America, their chief investment strategist, calling it maybe back to a, quote, Goldilocks bull levels. So one of the key charts in here that I always like to point out is the amount of investors expecting a soft landing where the Fed reaches that 2% inflation goal without hitting a recession versus a hard landing, maybe we'd get a recession. So soft landing is highlighted there in white. You can see the large tick up back that we've seen in that soft landing line over the last couple months. So soft landing now hitting its highest level of investors feeling that will be the most likely outcome in 8 months. And I think that sort of just speaks to the vibes that we've felt in the market over the last month and a half at this point, right? People are feeling better about the economy, recession odds are falling, and then you've seen a little bit of a more euphoric sort of trade going on within markets right now in sort of those momentum names, right? I was talking to Steve Stosnik over Interactive Brokers yesterday about this, and he said that you're definitely getting closer to euphoric levels in the market, maybe not quite there, but we were chatting through some of the names we've been taking a look at. You were just highlighting NVIDIA, that's back near a record high. Right. Palantir's back near a record high. Then you zoom in on some of the more popular, maybe retail-focused names that start to catch a bid when we're talking about momentum trades. Aquo up 80% over the last month, right? You take a look at those IPOs, CoreWeave, Circle have ripped since they've come public. And so you're starting to see the AI crypto, that kind of hype trade coming back into markets a little bit, and that's certainly expressed via sentiment among these investors.
Yeah, it's amazing that there are a ton of charts to break down, as always, within this fund manager survey, but one of them that jumped out to me was the investor sentiment improving to a 3-month high, but we also have to kind of take that with the context of this all too, and how far it's had to return from in the levels that we had seen it drop to earlier this year at the height of the uncertainty driven by tariffs.
Definitely, and Hardnett points out it's not worryingly bullish, right? So normally a lot of strategists would talk about if you get to sentiment levels that are extremely bullish, well, that's a contrarian bearish indicator, right? At this point, how long can everyone stay so bullish? That's not quite what people are arguing that we've sort of returned to, right? So we're still coming off the lows. One other chart, Brad, that was in here that I thought was interesting because we talk so much about tariffs, right? And where investor expectations lie around tariffs. Well, it's interesting because they survey a large group of investors, Bank of America does, and the average US tariff rate expected from these investors is about 13%. I would point out 13% is a little bit lower than what economists would say is the estimated effective tariff rate right now. That's usually in a range of 15 to 17%, depending on what street economists you talk to. But 10 to 15 is where investors expect. So that would mean consensus is expecting tariffs to come a little bit lower. That's a key thing to have in mind as we approach July 9th, right? Consensus still thinks tariffs are going to come down. If that tariff rate does not come down over the next couple months, perhaps that's maybe a risk and a headwind to markets.
And how many deals, if any, are netted out by July 9th, more than what we've seen, and where the negotiations advancing to the point where we could see another pause thereafter to still be able to reach that rate kind of long run.
July 9th's coming up soon, Brad. I'm excited that we have a date to just throw out again every day, like July 9th, it's coming, you know?
All right.
A little post 4th of July, post barbecue. We'll be in here talking July 9th.
Lib Day Part 2. All right. Thanks so much, Josh. It's time now for today's strategy session. Risk-off sentiment gripping today's trading action as stocks open in the red, but market momentum holding up some stocks. Trading near record highs. Can the market continue its rally despite a growing wall of worry for investors? Joining us now, we've got Kenny Pulkari, who is the Slatestone Wealth Chief Market Strategist. Kenny, one of the things that you and I were talking about in the break, and perhaps is within that wall of worry to a certain extent, is the retail sales print that came out this morning. What's your evaluation of that?
It appears, as you look at it right off the top, that it's weak, right? But if you really dig down into it, what you see is that it's auto sales and building material that really dragged it down. And look, you're not buying a car every day, and when people who haven't bought a car, when they go out and they see what the prices of cars are these days, then they take a second look and they think, well, maybe I'm going to keep the car I have for a little bit longer, because $70 or $80 or $90,000 for a car with a $1,200 or $1,500 a month payment just doesn't work. So I don't think it's the consumer that's unable to do it. I just think the consumer is choosing not to do it, right? But if you look at online sales, those are up. You look at furniture, those sales were up. So I don't think it's as negative as the headline number tells you. I just think that consumers are becoming more discerning because some prices are out of control, so they're just choosing not to buy it.
You mentioned building materials too. Is there anything we should extrapolate from that part of the print as well?
No, I don't think so. I think that you have to. People are going to. When I think of building materials, I think of like going to Home Depot and do-it-yourself stuff and updating the home that you're in. I think people are just taking a step back because they're wondering if housing prices are going to come down a little bit more. Maybe it's going to be an opportunity for them to get out of one and into another, and so they might just be taking a step back. But I don't think this report makes me nervous at all, because I just think that it's those two top line numbers that to me don't suggest retail sales. When I think of retail sales, I think you're going into TJ Maxx or Bloomingdale's, you're buying a shirt, you're buying clothes, you're buying shoes, you're buying, right? Yeah. Autos, while it's a retail sale, it's a very big retail sale, and I think the numbers for automobiles today are just causing people to take a step back.
You've got Middle East conflict, you've got an FOMC meeting kicking off, and we're approaching, as we were mentioning a moment ago, that July 9th deadline. With all of these factors at play, and certainly being weighed on the mind of investors, where are you prioritizing each matter?
Right, so I think you have to play it cautious. I remain cautiously optimistic, but look, the Middle East stuff and the geopolitical stuff is going to continue to cause anxiety and unrest in the markets. But remember, geopolitical stuff doesn't price stocks in the long term. They actually create short-term chaos, which then provides an opportunity for a long-term investor, because some people get nervous. They just want their cash. They don't want to own stocks in that environment. They just want to know that they have their money. Okay, great. So they sell stocks, not because the thesis has changed. on why you want to own Apple or Nvidia or Amazon, more because they're just afraid, right? And so when they dislocate the price of those stocks for a long-term investor that is not necessarily afraid, it's a buying opportunity for them. Now, if the thesis changes, that's a different story. But right now, the geopolitical stuff is not going to change the thesis for a range of stocks. In fact, it might even bolster the reason to go out and buy defense, aerospace and defense names, that kind of stuff, which are certainly catching a bid over the last couple of weeks.
One of the typical trades we see during times of conflict, and of course, not just sliding to the side, the humanitarian side as well, but of course, evaluating for our viewers watching exactly how this is impacting as well some of the thesis that's playing out in the market that we're seeing in response here.
And you got the Fed. You know, the meeting starts today.
Right.
You know, the announcement's tomorrow, 2:30. Then we're going to see the dot plot, which I always think is kind of interesting because it is just what it says. Yeah. These guys on the committee, they sit there with a pencil and they draw a little circle on a piece of graph paper.
Is that simple? Ticonderoga number two?
That's like, I hate to say it, it's like elementary school, right? They draw. There's nothing technological about it. And then they suggest, you know, it suggests where these guys, men and women, think rates are going to be. I think rates, look, you're not getting a cut tomorrow.
You think we get 50 basis points by the end of the year?
I don't. I'm still in the camp that he's not cutting rates. And I actually don't think he does. He should, because cutting rates is going to stimulate the economy, and the macro data continues, in my opinion, to be fairly robust. Unemployment's at 4.2%. That's closer to the lows than the highs by any stretch, right? And the other data, in my mind, continues to be strong enough. GDP is expected to be 3.8% in the second quarter.
Sure.
Right? That's a very strong number. So nothing there suggests to me that the economy's going off the edge.
It makes you wonder if we actually were in an economic emergency in order to trigger the tariffs.
100%.
That might be a different conversation. And people can listen in to many more of your conversations as well. Be sure to tune in to Trader Talk every Wednesday at 12 p.m. Eastern and scan the QR code below to stay up to date with all the latest episodes. Kenny, thank you.
Thanks for having me.
Coming up, we've got a closer look at the oil market as Iran and Israel exchange strikes for a fifth day. Stick around. More when Morning Brief returns. Gold prices hovering near 3,400 today as investors look to navigate geopolitical uncertainty. Meanwhile, Citi is lowering its short-term and long-term price targets for gold, saying prices could drop below $3,000 per ounce by late 2025 or early 2026. The bank citing declining investment demand and an improving global growth outlook, revising its 0 to 3 month price target to $3,300 per ounce from $3,500 per ounce. And its 6 to 12 month price target, that got revision too, to $2,800 per ounce from $3,000 per ounce. A different story for silver. Citi forecasting silver prices to rise to $40 per ounce over the next 12 months. And this is boosted by tightening availability and robust demand. The bank even saying silver could potentially reach $46 per ounce by the third quarter of 2025 in a bullish scenario. Today, silver prices remain around $37. Oil prices rising as conflict in the Middle East continues for a fifth day. This after prices declined yesterday on hopes for a ceasefire. Still, the International Energy Agency says that the global oil market is expected to remain well supplied through the end of the decade. Joining me now, we've got Daniel Dicker, who is the Energy Word founder. Daniel, good to have you back on the program with us. I just would like to start with your outlook for oil right now, given some of what we've already seen transpire in the Middle East.
Well, Brad, historically speaking, these kinds of Middle Eastern dust-ups haven't made much of an impact on global supply, but you know, there's always a first time, and this one has the wild card, of course, of Trump and you know, his mixed messages going into the war, being a part of it or being a supporter of Israel with armaments or more. So the supply problems that are inherent in the two combatants isn't much, either from Iran and certainly not from Israel. And the Iranians have only limited response to put pressure on oil, you know, in the Straits of Hormuz, which historically speaking hasn't been much of a threat. It's been well known inside Iran that the United States will not allow a closing of the Straits of Hormuz. So the threats tend to be ignored, and they have been for the most part ignored. So the question really becomes, you know, how much wider will this get? And the wild card, as I say, is the United States right now.
From what we've been able to track thus far, are there already ships that are trying to avoid even a wider radius or a wider zone, and thus could add to some of the near-term costs, at least for delivery, that has also a kind of knock-on effect to prices paid?
Brett, really, there's really not much there inside of the shipping issues. Again, these are very weak threats that the Iranians have made several times in the past, going back 10, 15, 20 years. And one time when there was an event between an Iranian gunboat and U.S. forces, was quickly made clear to the Iranians that it would not be tolerated in any way for shipping lanes to be shut down for Western supplies of oil coming out of Saudi Arabia and Dubai and what have you. So, again, these are, there might be some shipping lanes that are being given a slightly wider berth, but in terms of any, long-term difficulties with the Iranian side or the Iranian Straits of Hormuz, I don't see it.
And it seems like much of the contract pressures would be on anything that is expected to have to take delivery by the July contracts here. What most notably should we be looking out for past July if this were to still be a lingering issue into the early weeks of the month?
Right, and I think the assumption inside the oil market, because despite the $6 or $7 rally that we've seen in the last several sessions, it's not the kind of $10 jump based on this kind of event that used to happen, let's say, when the United States had a military action against Libya in 2010 or something like that. So for the most part, the oil markets, at least right now, are expecting that Israel will finish its job of taking out Iranian nuclear facilities and assets, maybe with the help of American bunker buster bombs. Let's try and say that 3 times fast. And then, basically retreat again back, having done what they came to do. I mean, this has been an expectation inside the oil market, inside the United States, and basically inside most of oil traders since the JCPOA was signed, that the Israelis at some point would make some preemptory strike on Iran and their nuclear assets, and here we are. So it's not entirely unexpected inside oil circles, and for right now, again, the entire wild card remains the widening of it based on what Trump in the United States does.
Just lastly, with the time that we have left, Dan, would love to get your read through from the International Energy Agency, who's now forecasting and expecting that the oil demand globally may peak by the end of the decade here. And it's interesting, especially knowing and kind of their read through of where demand could peak, and that is China. China's demand potentially peaking ahead of schedule. What's the significance of that from your read-through?
Yeah, I mean, this has been a long-standing issue that most others have agreed upon, is that the demand structure has been weakening over the course of the last several years and will continue to weaken until we reach some peak at some point. So it makes very interesting trading, or at least investing inside the energy space, particularly since today the Senate has decided to remove some of the solar incentives out of the budget. So it becomes a very interesting kind of investment kind of conundrum. Where do you go now, considering that oil is reaching the demand peak over the course of the next several years, and yet the incentivization for something to replace that inside the energy portfolio in the United States and globally is being sort of quashed by a Republican-controlled Senate and a Republican-controlled House and a Republican-controlled White House. So from an investment point of view, things are getting very interesting, I'd have to say.
Daniel, thanks so much for taking the time, as always. Appreciate your insights. Coming up, shares of Kraft-Heinz, they are on the move this morning to the upside fractionally as the company makes a major commitment to its U.S. products. That's after the break. Kraft-Heinz, the maker of Kool-Aid and Jell-O, among other popular food brands as well, announced it's removing artificial colors from its products by 2027. Yahoo Finance senior reporter Brooke DePalma has the details. Brooke, what do we know?
This comes as RFK Jr. and the Trump administration have really been cracking down on major consumer product good, food brands, snack brands to really remove artificial flavors by the end of the administration. So Kraft-Heinz making this big announcement this morning that it plans to get rid of all artificial flavors from the remaining 10% of its U.S. portfolio by the end of 2027. Now, they say that they will replace the artificial colors with natural colors, and where they can't do that, they will ultimately reinvent those products. They also announced that no new products effective today will use artificial dye, and once again, this does affect 10% of U.S. products. They say that that is the 10% remaining of the U.S. portfolio that still does use those artificial flavors. And so when you think about the products that are under the Kraft-Heinz umbrella, it's ones that come to mind here. It's the Kool-Aid, it's the Jell-O, it's also those jet puffed marshmallows. Those also use artificial dyes, as well as Crystal Light. So of course, over the next 2 years, we'll be keeping a closer look to see how exactly they quote unquote reinvent these products or replace these colors, and trying to understand how exactly they make, say, blue dye and green dye and invent it in new ways so that these products don't necessarily taste different, so there's no consumer pushback. But what we do know is that Kraft-Heinz, General Mills, WK Kellogg, those are all stocks that have been under pressure so far this year, not only because of the announcement of RFK Jr. cracking down on artificial dyes, but also as consumers get a bit picky about how exactly they're spending their discretionary dollars and whether or not they're going towards snacks here. So lots to watch in this space, but this announcement coming out this morning from Kraft-Heinz.
Okay, so
let's break this down.
Yeah, let's dive a little further into this, because I feel like I'm already personally invested and impacted considering my consumption of many of these products over the course of my life. But as we're thinking about how executives are positioning their companies to change operations, does it seem like any of them are ahead of the curve on that effort?
Yeah, I mean, they say they've been doing this over the past few years. Okay. Back in 2016, they removed the artificial dyes from the Kraft mac and cheese. And so they seem like they're well positioned to make these changes. Of course, yet to be seen how much exactly this reinvention will cost here.
All right, Brooke, I'm going to be watching closely next time I make some Kool-Aid or any of the, I don't know.
Powdered mix?
Yeah, the powdered mixes. I don't know. I've kind of removed them from my pantry anyway. Brooke, thank you. That does it for Morning Brief, everyone. Join me in the next hour for more on Catalysts.